Okay. Okay. So who's on the line? Hello?
Yes, sir. You're on with our 4 panelists today, and the ranking member will be joining shortly.
Okay. And do we have many other members involved?
Katrina, do you want to announce?
Statement. I want to thank everybody who's involved in this discussion. We look forward to putting together a hearing as opposed to a roundtable as soon as possible. We hope to involve government witnesses in that hearing. The Fed is telling us that they have something they call a blackout period. Jay Clayton has said in principle he'd like to speak to our subcommittee. So we look forward to putting something together. As we examine the impacts of COVID-19 on our capital markets, we see that our capital markets have gone through quite a stress test and have come through. The stock market volatility measured by the VIX index hit an all-time high of 82.7. Daily municipal bond trades hit a peak triple their average number of transactions, and we have seen the market do well even under these conditions and under some of the most stressful conditions with up until recently by traders working from home. We do want to focus on some of the problems relevant to our subcommittee. The first of these is the attempt by the Fed and the Treasury to connive a way around the requirements of the bills we've passed dealing with loans to single large corporations. When a corporation accepts such a loan, they are supposed to be subject to certain requirements, including no stock buybacks, and the restructuring of a loan to a company in the form of, well, do a new bond issue and the government will buy virtually all of the bonds issued. That is a connivance to get around the statutory requirements. We also want to look at the Fed's decision to rely on only certain bond rating agencies, the SEC's encouraging issuers to describe how the pandemic has affected them. We want to go beyond that to requiring public companies to tell their shareholders how they've been affected. So with that, I'd like to recognize our ranking member, Mr. Huizenga, for his introductory remarks.
I think we're going to go to ranking member McHenry if he's on.
Is Mr. Huizenga or Mr. McHenry available?
Perhaps we could move to introducing the panelists.
Okay. I now have both my devices working here. Hello, by the way, is our chairwoman on the call?
No,
Hello?
sir. Not at the moment.
Okay. I'd like to welcome our panelists. First, I'd like to
Hello.
welcome,
You now have me unmuted.
hello?
Yes, Mr.
Christopher
McHenry.
This is
Gerold, President of the
fantastic.
North American Securities Administrators Association and Chief of the New Jersey Bureau of Securities. As Bureau Chief, Mr. Gerold is responsible for the administration and enforcement of New Jersey's
Well,
uniform.
if you can hear me, I'm going to ask French Hill to,
Hello?
since Bill Huizenga is not yet on, I'm going to ask French Hill to kick this off, and I'll just, I'll watch it when it's done, when it's on YouTube. So,
Hello?
Yes, Mr. Sherman. I believe Mr. McHenry was speaking. He was just able to get back in onto the call and asked for Mr. Hill to give introductory remarks.
Well, certainly the minority should have an opening statement, and so let us proceed.
Mr. Hill, you are currently muted at the moment.
How about that?
Yes, that's much better. Thank you, sir.
It's a challenge for all members of Congress to learn the 42 different video platforms we're supposed to master in the face of the pandemic. So apologies to our patient panelists. We look forward to hearing you in the roundtable. It's good to be with you. I thank the ranking member for yielding to me. I just would say, first and foremost, Mr. Sherman's recitation of the market's recovery, I think, is clearly due to the leadership of the Fed and the Treasury acting quickly on Sunday, March 15th, and putting in place important facilities that calm the markets, both the bond markets and the stock markets, narrowed spreads, reduced the volatility index dramatically from its peaks, and cut spreads for both high-grade bonds and high-yield bonds in half, just by simply stepping up and taking prompt action in the primary dealer markets, in the money market accounts. So similar to their prompt action in 08, the markets were calmed by that. And we saw unprecedented bond issues without any government interference, without any government credit enhancement, both in high yield and high grade bonds. I mean, record issuances. I don't have the numbers sitting in front of me, but running maybe at 3 or 4x normal quarterly issuance of both high yield bonds and high grade bonds. So I'm delighted that the Fed and the Treasury acted quickly in March. I look forward to this discussion about the capital markets during the pandemic and hear new ideas from our panelists of something that members on both sides of the aisle should be focused on. And with that, I'll yield back to the chair, and thanks for the time.
Thank you. We will now hear from Mr. Gerold, who is responsible for New Jersey's uniform securities law with the primary mission of protecting New Jersey investors. Mr. Gerold, please give your introductory remarks.
Good afternoon. My name is Christopher Gerold. I'm the president of the North American Securities Administrators Association, or NASA for short, which is the association of U.S. state and territorial securities regulators. I appreciate the opportunity to join you and my fellow panelists today. In response to the pandemic, NASA has formed a working group of state regulators to assist our members in providing limited regulatory relief necessary to ensure continued operations of the financial services industry. Members of the working group also continued ongoing coordination with the SEC and FINRA and formed a COVID enforcement task force to identify and stop potential fraudulent schemes related to the pandemic. On the legislative front, we have urged Congress to pass the Senior Security Act and introduce the draft Empowering States to Protect Seniors from Bad Actors Act to increase protection for seniors from pandemic-related frauds. During our discussion today, I think it's important to remember that neither the securities laws nor the functioning of our capital markets are the root cause of the present economic distress. Prior to the pandemic, the securities laws and our capital markets were serving their intended purposes, the protection of investors and allocation of investment capital. This remains true here today. At a time when many of our national institutions appear to be underprepared, the securities markets and most financial services firms have functioned and continue to function without significant interruption. Congress has taken significant steps to address the adverse impact of the pandemic on businesses. However, Congress should be very skeptical of proposals that would weaken the securities laws in the name of the crisis. NASA recently made legislative recommendations in the wake of COVID-19. They set forth concrete steps that Congress could take to close gaps in investor protections. I've included a copy of these recommendations as background materials and am pleased to discuss them today. Now, however, I'd like to address principles and priorities I believe Congress should keep front of mind as it contemplates additional legislation. First, Congress should support increased transparency in the private marketplace. As a result of the transparency that is a hallmark of our public markets, we have a clear understanding of how these markets have functioned during the pandemic. The same cannot be said for private markets. In 2018, the SEC estimated that approximately $2.9 trillion was raised through exempt offerings, surpassing the capital raised in the public markets. Yet, we know very little about how these markets function. Second, and relatedly, Congress should consider imposing a pause on major SEC rulemakings, especially on efforts designed to expand private offerings in private markets. NASA and others have expressed strong concerns about the dramatic expansion of the private markets. Despite the fact that the economy has changed profoundly since then, the SEC so far appears intent on proceeding with a deregulatory agenda as if little has changed. This should concern the committee. Third, we need to ensure continued and, where necessary, expanded disclosures by public companies. Our public markets are the gold standard for investors across the globe because they are transparent and well regulated. Now more than ever, Congress must support and work with securities regulators to keep fraud out of our capital markets. Thank you again for the invitation to participate in today's panel, and I look forward to the Q&A. Thank you.
Thank you. Congress has focused a lot of our attention on helping the small business sector. So I'd like to introduce next Brett Palmer, President of the Small Business Investor Alliance. Mr. Palmer has testified before our committee before and has served both in the executive branch and as a policy aide to the Speaker of the House here in the legislative branch. Mr. Palmer has well designed his visuals to have the name of his organization right over his right shoulder as he testifies, something he will probably not be able to do when he testifies in person in room 2128. But now well framed with his logo in the back of the frame, Mr. Palmer.
Thank you very much. My name is Brett Palmer, President of the Small Business Investor Alliance. I'd like to thank you all for giving me a chance to participate in this forum. Our members provide capital and expertise to help small businesses grow, from small to medium-sized businesses, creating jobs and supporting communities along the way. Tens of millions of Americans have lost their jobs or are in fear of losing their jobs. Millions of small businesses are under severe distress and don't know if they're going to make it. For this, Congress has acted in a collaborative way to create and fund lifeline programs and make regulatory changes. For example, the Paycheck Protection Program was created and implemented with incredible speed, and the SEC has taken many adaptive actions. Banking regulators have encouraged behavior that supports and not harms small businesses. And I want to thank all of you and all the public servants for this help, because the country needs more collaborative, practical solutions that support small businesses and create and sustain jobs. We're going to discuss some of the challenges with the emergency programs and emergency regulatory actions and how to address them. But it is important not to overlook the success and the benefits these programs and actions have produced. There are millions of American families that still have a breadwinner, and there are millions of families that can maintain their health insurance. There are millions of small businesses that will survive because of the actions and collaboration of this Congress with this administration. The recent emergency efforts have had some bumps and imperfections, but these emergency actions were a successful lifeline for millions. Now that the economic picture is beginning to come a little bit clearer, small businesses will need more flexibility to adapt to the new environment and will need more access to capital. we need to remember that we are only experiencing the first wave of impacts of this economic and biological disaster. There'll be second and third wave impacts that we know are coming, and a whole lot of impacts that we don't yet see. The remaining unknowns are very large, and policy must continuously be adapted to our new economic situation. The government needs to begin to pivot, to think about how to prepare small businesses for what they will need in 3 months, 6 months, even a year from now. And you now have the time to be thoughtful and deliberative and forward-looking, because when the last bill was being moved, things were moving very quickly. Congress needs to take this opportunity to update the statutes and regulations that might create barriers to access to capital for small and medium-sized business. Because here are some of the emerging problems that small businesses face or will soon be facing. Coming out of the shutdown, many small businesses will be unbankable for loans. They'll be up to their ears in debt. They'll be rebuilding their workforces. Their finances and credit may be in shambles, but they still may be able to heal and grow if given the chance and the resources. So small businesses are going to need access to more patient capital, more equity, and more equity-like capital. We would encourage greater flexibility for the Paycheck Protection Program. They will need access to both bank loans and private capital markets from business development companies, small business investment companies, rural business investment companies, and small private equity. They need access to SBA products, and they'll need the Main Street facility, which needs to get up and running as soon as possible. It should be broadly available. There are many good bipartisan bills that passed in recent years that were included in the Jobs Act 3.0 and that should be revisited or taken up again, such as the HALOS Act or the Small Business M&A Simplification Bill. And there are many other modest improvements that can be taken up now to provide a better capital market for small and medium-sized businesses, for micro businesses and underserved communities. I'd be happy to discuss these issues further and answer any questions you may have. Yield back.
Thank you. We now move on to Heather Slavkin Corzo, Head of U.S. Policy for Principles for Responsible Investment, the world's leading proponent of responsible investment, with over 3,000 signatories globally who invest over $90 trillion. Prior to joining a current organization, Ms. Slavkin Corzo worked with the AFL-CIO and was director of the AFL-CIO Office of Investment from 2014 to 2018. Ms. Slavkin Corzo, please give your opening remarks.
Thank you, and thank you for the opportunity to participate in today's roundtable. As the chair mentioned, the PRI is the world's leading proponent of responsible investment. Globally, we have more than 3,000 signatories with more than $90 trillion in assets under management who have all signed on to these principles aimed at helping them to invest more sustainably. I welcome the opportunity to speak to you as the pandemic evolves from a health crisis into an economic one. The impact the pandemic has had on our financial system is evolving. The Federal Reserve's actions have helped to stabilize financial markets. This stability, however, does not reflect the economy as it's experienced by everyday people. 38 million workers have filed for unemployment since pandemic-related shutdowns began. Major American retail, entertainment, and oil and gas companies have filed for bankruptcy. As economists increasingly warn that the U.S. will not experience a V-shaped recovery, individuals and businesses will increasingly be unable to pay their bills. This will impact the financial markets, though nobody knows how deep the losses will be. Long before the pandemic, leading economists began raising alarms that businesses had taken on too much debt, and that would make the next downturn more difficult. The crisis is exacerbating existing weaknesses in the financial system and the broader economy. The investors I speak to tell me that they are realizing business practices they always thought of as moral issues, like healthcare, paid leave, and worker pay, are turning out to impact their investments. And they know that future crises like climate change will as well. We have the opportunity to rebuild a system that is better, one that is more sustainable and fair. This makes moral sense and economic sense. This means better reporting on how companies are protecting their workers, requiring companies that receive government financial support to retain workers, provide paid sick and family leave, and institute practices for worker safety and health. Requiring companies that receive aid to adopt responsible practices, including limitations on executive pay, bans on stock buybacks, and practices that mitigate their carbon footprint, and focusing stimulus on projects that build a more sustainable economy. Governments will have to address climate change. The PRI has developed the Inevitable Policy Response, which recommends policies and estimates their economic impact. The longer we wait, the more costly the transition will be. Let's start now. There are some who are advocating deregulation of securities markets and rolling back investor rights in response to the crisis. This is the wrong way to proceed. Investor confidence depends on fair, transparent markets where there are strong mechanisms to make their voices heard during times of crisis. Policy responses must be aimed at creating a better, stronger, more sustainable, resilient economy. Thank you, and I look forward to the opportunity for questions.
Thank you. I have boarded so many flights of United Airlines that they give me a very high status. With us today is a man who is very much entitled to status as a frequent flyer with our committee, Mr. Tom Quaadman, Executive Vice President of the U.S. Chamber Center for Capital Markets Competitiveness. Mr. Quaadman oversees the center's policy and lobbying operations, and as I indicated earlier, has testified before our committee on many, many occasions. Mr. Quaadman.
Thank you, Chairman Sherman, Ranking Member McHenry, members of the subcommittee. Thank you for the opportunity to participate in this roundtable on the impacts of the COVID-19 pandemic on U.S. capital markets. Since stay-at-home orders were issued in March, many sectors of the economy have come to a standstill. Nearly 39 million Americans have filed for unemployment benefits, and businesses of every size need capital in order to survive. The CARES Act, or the PPP, has provided temporary payroll relief for small businesses, while the Federal Reserve lending facilities have kept capital markets liquid and functioning for larger businesses. The Main Street Lending Program, expected to come online in days, is targeted to help middle market companies that employ 68 million Americans. This quick action by Congress will be critical in saving jobs, stabilizing businesses, and putting the nation on the road to recovery. Restarting the economy will have its own challenges. We should explore means to inject private investment into the American economy. Persistent issues such as a lack of decision-useful information for investors, a lack of liquidity for smaller businesses, and barriers to investment continue to exist. These issues have caused our capital markets to underperform and may hinder economic recovery. The SEC has already enacted timely and targeted relief for companies by extending disclosure filing deadlines, permitting small businesses to pursue expedited crowdfunding offerings, and allowing BDCs to provide additional financial support for their portfolio companies. The SEC's regulatory agenda contains several provisions that would help increase access to capital and reduce regulatory burdens during this time. These include modifications to crowdfunding, harmonizing exempt offerings, amendments to the definition of an accredited investor, and disclosure simplification. These rulemaking should be finalized and implemented without delay, and the SEC has stated it has the capacity to continue this agenda while managing the COVID crisis. Finally, there are several proposals that Congress should consider that would expand opportunities for capital. Much of the bipartisan Jobs Act 3.0 package, negotiated by Chairwoman Waters, is even more timely. Swift enactment of the Jobs Act 3.0 would assist thinly traded securities, improve investment research, facilitate follow-on investments for venture capital, and provide investors with more opportunity. There are new helpful proposals under consideration, including allowing companies greater leeway to grant employee equity compensation, as well as temporarily extending EGC status for companies expected to phase out during the pandemic. We should avoid proposals that could harm the ability of businesses to grow, including one-size-fits-all mandated ESG disclosures or further restrictions on dividends and stock buybacks that may harm investors. We also look forward to working with Congress to carefully consider measures of critical import for our capital markets, such as measures to delist Chinese companies from U.S. exchanges. This is an issue that warrants further discussion and in a different forum. Thank you, and I look forward to this discussion.
Thank you, and thank you for mentioning our efforts to make sure that all the companies, including Chinese companies, that are listed on U.S. exchanges provide investors with the auditing assurances that we insist on for U.S.-based companies. With that, I'm going to ask staff to announced a list of people in order that they will be recognized in an in-person hearing. I look around and see when I'm likely to be given my 3 to 5 minutes, but there's no way for people to do that now. So if staff can identify in what order members will be called upon.
Thank you. Mr. Sherman, we'll start with you for your questions. You will now have 3 minutes.
Okay, but can you tell the other members what order? Do you have the list there?
Yes, sir.
Well,
And
why don't you go through the list so people know when they're likely to come up?
sure. So first we'll start with you, Mr. Sherman, and then go to Mr. Huizenga. After that, Mr. Scott, and then Mr. Stivers. And then we will go to Mr. Foster, and then Mrs. Wagner, Mr. Meeks, then Mr. Hill, and then Mr. Gonzalez and Mr. Style. And we can also, once more members join, if they're able to, we will also recognize those members as well.
Thank you so much. People don't need to look around the room to see when they're likely to be called upon. Ms. Corzo, the first question will go to you. We decided when we passed the CARES Act that if the Fed just buys a bond, perhaps one that was issued several years ago, that doesn't impose duties on the issuing company. Heck, they sold the bond years ago. But if a company accepts a loan of taxpayer money, then they'll be subject to certain restrictions. Most important of these was no share buybacks, since something the public would certainly reject is the idea that we loan money to a company on Monday and they use funds to buy back their stock on Tuesday. On April 9th, the Fed announced that it would increase the size and scope of the primary dealer credit facility through a $50 billion equity investment from the Treasury. This facility is purchasing eligible corporate bonds as, and here's the key phrase, sole investor in a bond issuance. The effect of this is in effect to make a loan to the company, since the money goes straight from the Fed to a bond purchase where the government is pretty much the sole purchaser of the bonds. But the Fed has indicated that the corporate issuers can take advantage of the program without complying with the CARES loan conditions. So what we see is a connivance to get around the requirements in the law that not only adversely affects this program, but undermines trust here in Washington. We Democrats negotiated for certain restrictions. Republicans negotiated to have fewer restrictions. We agreed on what those restrictions would be on companies getting federal loans, and now a connivance is used to take away those that Republicans agreed to. So I would ask you, do you see any reason why companies who are accepting federal money by the government being the direct purchaser of substantially all of the new bond issuance should not be subject at least to the requirements that Republicans voted for as well as Democrats?
No, in fact, I see profound reasons that we should be encouraging companies to maintain as much cash as possible so that they can maintain employment and invest in their future growth.
Thank you. And I want to go on now to Mr. Palmer. Since 2007, the SEC's acquired funds, fees, and expenses disclosure requirement, known as AFFE, has applied to business development companies, BDCs, while not being applied in a similar manner to similar entities such as REITs. I understand that this has resulted in BDCs being excluded from many indexes. Has this undermined our efforts to help small business at this critical time?
It has. It's done a couple things. One, it means that the AFFE, as it relates to BDCs, is giving the wrong number. And two, it means that for retail investors, they're not getting the benefit of having institutional investors alongside them doing oversight of those businesses. And in the process, it's reducing the amount of capital flowing into BDCs that would then be passed through to medium and smaller sized businesses. So getting an updated AFFE for BDCs would be helpful for getting small and medium-sized businesses access to capital and give a more accurate reflection of the fund fees and expenses.
Thank you. And the support for small business is overwhelming here in Congress. We passed CARES, then we dropped everything to pass an additional funding of the PPP program. And now we're on the verge of passing additional liberalizations to the PPP program. And I would hope that our friends at the SEC would see the importance of small business that we in Congress see. With that, I believe Mr. Huizenga should be recognized.
Yes, Mr. Huizenga, you will now have 3 minutes for your questions if you are on. If not, we'll go to Mr. Stivers, which you will have 3 minutes for your questions.
Sorry, I was muted. I apologize. My first question is a follow-up to what the chairman just asked Mr. Palmer. Mr. Palmer, can you help us understand how the AFFE should be revised so that business development companies will not be at a competitive disadvantage and will be able to lend more to small businesses?
Thank you, Congressman. Happy to answer that question. They should modify the AFFE as relates to BDCs so that it accurately reflects what the expenses are and it doesn't over exaggerate or amplify the fees, which have effectively made it impossible to have BDCs on the exchanges. So just getting a clarification that it's treated like other REITs and other things that are considered on by the AFFE would do a lot to provide some institutional oversight of the BDC industry and provide more capital to small and medium-sized businesses.
Thank you. Can you help us understand, obviously Congress could fix that as well. The SEC is in the process of looking at their AFFE, I've been told, but they won't tell us whether this is on the table or not. Do you think this is something we should put in if we do something else on COVID-related matters to ensure that BDCs can get more capital to small businesses?
It would be helpful. It would be nice if the SEC would do it on their own, but it certainly would be helpful to fix a number of points of friction for the capital markets that are supplying capital to small, medium-sized businesses, and this would be one of them. So yes.
Great.
Thank you.
Thank you. My next question is for Mr. Quaadman. The SEC provided lots of different temporary relief measures for market participants during the crisis, and I think that's important. But when we're thinking about long-term, are there things this crisis is revealing that should result in permanent changes to laws, regulations, or even how we think about the financial markets?
Yeah, thank you very much for that question, Mr. Stivers. I think there are a few areas where the SEC should move forward in terms of providing permanent changes. As I outlined in my statement, we need to have ensure that we have scaled disclosures to balance both the investor needs as well as the cost for emerging growth companies. Extending the period for extending emerging growth company status is important as well, though that would require congressional action. I would also say there are other areas, including proxy advisory firm reform, which would be helpful to help businesses to go public, as well as providing other areas such as crowdfunding changes as well.
My time has expired. I yield back.
Thank you. We will now go to Mr. Scott for 3 minutes for his questions.
Thank you. Mr. Gerold, I am very concerned about these scammers that are out there who are taking advantage of our retail investors and putting forth fake companies that they say, for example, they have a cure for COVID-19. They have a way of preventing it. And I want you to share with us just how serious this is, what you all are doing about it. I know the SEC is gone ahead and invested some people? And then finally, what more do we in Congress need to do to put forth measures to protect our American retail investors from these frauds?
Thank you. Thank you, sir. So the threat is real. It is absolutely out there. There are scammers trying to take money from investors. We have responded. Certainly the SEC has responded. FINRA has responded. We've coordinated with them on that. We've also launched our own independent NASA COVID enforcement task force, where we're not only receiving referrals and complaints, but we're proactively going out looking for websites and social media posts, identifying them and taking action against them. And so all regulators have really responded in this area in a coordinated way to this very real threat that's out there. On the policy side, there are a couple of items that can certainly help us respond to the pandemic. One of them would be the Senior Security Act, which would establish an interdivisional SEC task force that will focus on issues impacting elderly investors especially. And then also the Empowering States to Protect Seniors from Bad Actors Act, which would modify the Dodd-Frank Act, Section 989A, which would be a grant program available to states to apply for taking action and educating and protecting seniors. And certainly seniors are the most vulnerable to opportunistic frauds and pandemic-related frauds. So yeah, certainly areas.
How serious is it? What do you have any information in terms of monetary value? Have they any been getting away with it? And then what is the status of each of these bills that you've mentioned?
Sure. So the status is it's billions of dollars, tens of thousands of investors at least are being impacted.
Wow.
The Senior Security Act has been voted in the House, and it has received overwhelming support. It's a bipartisan bill. It's now pending, and it has been introduced in the Senate by Senators Sinema and Collins, and pending with 4 Republican co-sponsors and 4 Democratic co-sponsors. And Chairman Clayton has endorsed the legislation.
Thank you very much.
Thank you.
Thank you. We'll now go to Ms. Wagner for 3 minutes for her questions.
Thank you, Chairman Sherman and Ranking Member Huizenga, for hosting this roundtable today, and thank you to our panelists for joining us to discuss the impacts of the coronavirus pandemic on America's capital markets. I will be quick since I only have 3 minutes. My question is directed to Mr. Quaadman. Mr. Quaadman, as you know, over the past few months, as investors and companies have responded to the economic uncertainty of the pandemic, many businesses have drawn down credit lines, and some have sought to preserve their cash in the safety of bank deposits, which caused substantial balance sheet growth and has resulted in a significant increase in a bank's total assets, which they must hold capital against. How would amending the Dodd-Frank Act's Collins Amendment, which created statutory minimum capital requirements, help to ensure that financial institutions can continue to intermediate relief programs and serve businesses and consumers during this very unprecedented health crisis?
Ms. Wagner, thank you very much for that question. I would say, number one, we should remember that our well-capitalized banking system has been an important bulwark against the economic winds that our business community is currently facing. However, for the past several years, we've been warning about the interaction of the various different Basel III capital requirements, along with the Collins Amendment, that creates perverse incentives that prevent banks from either accepting deposits or lending money out. What we need now is for businesses and customers to be able to put their money in a place that's safe, as well as for increased lending. We are seeing where the Collins Amendment is acting as a friction point in both, that it would prevent deposits from being accepted. We have not only have we called upon the Senate Banking Committee 2 weeks ago to start making these changes, but Vice Chairman Randall Quarles from the Federal Reserve also asked for legislation to make similar adjustments to ensure that the banking sector can continue its effectiveness in this crisis.
Well, I thank you for your answer, and I saw that Quarles had done that, and this is something that we really need to address in an expedited fashion, I believe. So I thank you. I believe my time has run out, Mr. Chairman, so I yield back. Thank you.
We will next go to Mr. Foster for 3 minutes for his questions. Mr. Foster, you're currently muted at the moment.
Oh, is audio okay here?
Yes, sir.
Okay. Well, I'd like to speak for a moment about any lessons that we may have learned from COVID about disclosure requirements. The SEC has issued an order that gives public companies a 45-day extension to file certain disclosure reports that otherwise would have been due, I think, between March 1st and July 1st, provided that they file a current report that summarizes the need for this delay, as well as any risk factors related to the impact of COVID-19. So the first question is, anyone know, I'm just curious, what is the uptake by companies on this filing delay? Have they taken this deal or just issued standard reports? Does anyone have any comments or observations on that?
Mr. Foster, this is Tom Quaadman. I can tell you anecdotally, having spoken to many different companies, companies are trying to ensure that they can get the information that investors need and that they're trying to do within the parameters of the SEC's guidance. So I believe companies are working through that SEC guidance to provide that information.
Okay, yeah, so that's useful and good. Yeah.
Go ahead.
Yeah.
I haven't spoken with any companies, but I have heard from investors. And what I'm hearing from investors is that there's a concern about lack of access to sufficient data about how companies are responding to the crisis and how they are working to protect their workers and ensure that they're ready for growth on the other side of the pandemic. And so what they're telling me is that they're very concerned about the Commission's actions to allow delay. They want more information, not less information.
Yep. And so, yeah, this is going to be a tough balance to strike here. You know, two of the big impacts of COVID-19 have been on companies' supply chain disruption and on workforce disruption. And so the impact of this has obviously been very different on different companies. And the disclosures that I've seen so far have been very generic. I'm just curious to what you've seen, you know, particularly in regards to the ongoing discussion of bringing the supply chains back home, for example, in pharma. And what, you know, are there missing disclosure items, things that should be strengthened in regards to supply chain and workforce issues?
Well, Mr. Foster, this is Tom Quaadman again. I would just say you have to remember, particularly with companies that have more complex supply chains, the actions of how companies can get restarted is subject to government order, which is by governors of states. So companies have to put this together on a very piecemeal basis. So they're trying to get out that information as quickly as possible. And additionally, Chairman Clayton and Bill Hinman have also indicated that there are going to be certain safe harbors. So I think there are some difficulties in a very unprecedented circumstance trying to collect that information. But companies are trying to make a good faith effort to try and get that information out there for the investing public.
For investors, investors are being asked to put up their money right now to help businesses continue through the crisis. And they're being asked to do so with a lack of information about how the companies are responding. We know, for example, look at the meatpacking industry. We know that a failure to adequately respond and protect worker safety and health as a result of the virus has an impact on supply chains. It has an impact on companies' bottom line. When you see dozens of businesses having to shut down because their workers are getting sick, this impacts investors, and we don't have the information that we need in order to understand what's happening.
I'd like to add something there, Congressman, if you wouldn't mind. This is Brett Palmer with the Small Business Investor Alliance. I think there's a scale issue here too. And so as a trade association, we have both the fund managers that are investing into small businesses, as well as the institutional investors who put their money into those funds. So we have both sides of that equation. And a lot of those institutional investors really are craving information, but they're trying to modulate how much they're demanding of the people that are running the businesses so they can focus on running those businesses, keeping an ongoing business, keeping it safe. And so it really is a struggle, and it's hard. The smaller business you get down to, the harder it is to manage both of those. So my experience so far has been people have been very responsive as best they can, but it's something that's going to continue to adapt as this disease has adapted in ways that we frankly haven't seen play out in ways.
Well, thank you. And we're going to need a lot more than 3 minutes to discuss this issue going forward.
Thank you, Congressman.
Thank you, Mr. Foster. We'll now go to Mr. Hill for 3 minutes for his question.
Thank you, Chairman, and appreciate you having this roundtable. Appreciate our witnesses again. Just a couple of comments based on the Chairman's opening comments. First of all, the primary and secondary corporate market facilities that the Fed stood up and he referenced an April 9th release around those. Those are obviously of prime interest to the Congressional Oversight Commission. They were the subject of our questions in our first commission report that we released last week. So we'll be following up on that. I think it's a bit of a pejorative to refer to it as a connivance, though. I'm not sure that's anything other than your possible personal opinion. And the facilities really have not been put in use principally because the bond market recovered so quickly in March and people were able to go to that primary corporate bond market for both high yield and high grade and be satisfied under market conditions there. Also, I do share your concern, though, over the rating comment that you made. That's an issue I've heard from a lot of members on both sides of the aisle, that we have our rating or companies and they're all covered by the rating agencies overseen by the SEC, but that the Fed has not chosen to use or accept all those ratings. So that's something that will be also was a question of the Oversight Commission. Let me turn my comments, if I could, to Mr. Quaadman. Two issues that refer to access of credit in the markets. Both are bills that I've introduced in past Congresses, and some have passed in those Congresses with my friend Mr. Schweikert from Arizona. One is to expand the definition of accredited investors, to make sure people who have professional expertise, scientific expertise, could be able to participate in a Reg D offering. And the second one I haven't introduced in this Congress, but Mr. Schweikert and I are getting ready to introduce in this Congress, is an ability to let crowdfunding be exempt from the S-Corp rules and have an exception there. Could I get your comments, Mr. Quaadman, on the FAIR Act for accredited investors and the S-Corp expansion?
Yeah, thank you very much for those questions, Mr. Hill. Number one, the changes to the accredited investor definitions is well overdue. We have people with deep expertise, deep education that can handle investments, and we need to expand that. And this is also important too for the democratization of our capital markets, where we've cut off many people from sharing in those benefits. Secondly, with crowdfunding and expanding that to S corporations, that is something that we would also support. I think various different means of allowing the public to invest in smaller corporations. There are other proposals out there, including crowdfunding with SPVs as well as microlending. We think that in combination with your S-Corp idea would be very powerful.
Thank you for your time. I yield back, Mr. Chairman. Thank you for the time.
In order for the capital markets to work, you need to have sellers and you need to have buyers. And the more that you take away protections from buyers, the harder it is going to be to get people to come to the markets and actually participate.
Yield back, Mr. Chairman.
Thank you. We will now go to Mr. Meeks for 3 minutes for his questions.
Thank you. Thank you, Chairman Sherman, for having this important meeting. Let me ask, a lot of my constituents are asking me a couple of questions, and so I guess I'll ask Mr. Quaadman first. There seems to be a disconnect between the stock market and the real economy during this crisis. They looked at, some of my constituents come up to me and they see, that the market is going up, and they then look at the real economy and people that are suffering. And so then they come to me, because when we talk about previously the stock market being a signal of what the reality is as far as our economy is, it seems to be that complete disconnect. You see more folks are going on unemployment now, and our growth is negative. Can you explain? Tell me, how do you explain for us why the stock market has so significantly, but unemployment is where it is?
Yes, thank you very much for that question, Mr. Meeks. Number one, the stock market is traditionally a leading indicator of economic activity. So the stock market is actually going to reflect economic activity about 6 months into the future. So as we're seeing even today with the stock market going up by 600 points when it first opened, that is based on the reopening orders that are occurring and an anticipation of future economic activity. The other issue I would just raise, when we were in mid-March, we were seeing all of the different capital markets seizing up. That is why the different facilities that Mr. Hill was referencing were so critical, even their existence in getting that back up and running. And that liquidity has also helped the stock market to bounce back. Our hope is, and this is why we've supported the CARES Act, is that if we keep workers closely tethered to their businesses, that as they start to reopen, they can immediately go back to work. So there's unfortunate short-term pain, but hopefully those stock market gains that we're seeing today are going to indicate a very strong economic recovery in the very short future.
Let me ask you another question real quick. As you know, I'm from New York, and I'm completely undecided. I know the chairman has a bill that's talking about maybe delisting some of the Chinese companies from the American stock exchanges. Coming from New York, what do you think that would be a benefit to New York vis-a-vis Hong Kong or Shanghai and London? How do you think we make out on that?
Yeah, thank you for that question, Mr. Meeks. Number one, our capital markets are based upon transparency and disclosure. And the SEC and PCAOB have been able to work out reciprocal inspection agreements with other jurisdictions, even if there are differences based on those two principles. Any company that cannot abide by listing standards or those fundamental principles, whether they're domestic or international, would be delisted. So our hope is that we can come to some sort of agreement with China on these issues, but I think we can talk about that more in the future.
Thank you.
Thank you. We will now go to Mr. Mooney for 3 minutes for his questions. If not, we'll go to Mr. Gonzalez for 3 minutes for his questions.
Thank you, and thank you for putting this discussion together. Mr. Palmer, I want to start with you with my line of questioning. You mentioned in your opening the desire and the need to have more flexibility on the PPP program. Couldn't agree with you more. In particular, when you look at those in the hospitality space, whether that's restaurants or hotels, the program just quite frankly doesn't work for them all that well, the way it's currently constructed. As you may be aware, we're set to vote on a bill that would increase flexibility by waiving the 75-25% rule, and then also increasing the payback period to 24 weeks. When you talk about flexibility, is that what you have in mind? I'm not going to ask you to endorse the bill specifically, but what sorts of flexibilities are you looking for there?
Things like that. I mean, when this law was created, we didn't know how long it was going to last. We just knew it was going to be serious. And so it was a best case effort going into a storm. This has lasted longer than I think most people expected. We're now into a seasonal work period where we have a lot of workers in seasonal industries that need that longer period to do it. You also have businesses that the good news is they're using it to keep people employed and save tens of millions of jobs. But they may need to keep their business operational and be able to use some of that money for keeping rent or supplies or other things. So yeah, I think as long as it stays consistent with the purpose, which is to keep small businesses whole so they can survive this economic seizure and grow out of it and keep employees employed with paychecks and health benefits and things like that, I think that more flexibility, the better off we all are.
Yeah, and it's really though it's more about it's the Paycheck Protection Program, right? I think there's been confusion post where folks have said, hey, this is really about shoring up small business balance sheets, and that's not actually what it is. It is more about keeping workers connected to their benefits and their job. So personally, I am for more flexibility. I actually think we should be looking at a specific bill for certain industries where this doesn't fit all that well, but that was helpful. I appreciate that. And then, Mr. Quaadman, I know you don't want to get too far into the weeds on the PCAOB issue with respect to China, but I would just like your feedback on this. So the way I see it is we have companies listing on American stock exchanges, invested in by American investors, and they need to be in that world subjected to PCAOB covered audits. Would be my argument. What is sort of the counter to that in your estimation? Why wouldn't we demand, especially from Chinese companies, why wouldn't we demand the same level of audit protection that we have for other businesses that list on our stock exchanges?
No, that's exactly the question, and that's why the PCAOB and the SEC have reciprocal agreements with other jurisdictions. We've been unable to come up with a similar agreement with China, and that's exactly the rub, because we need to have that level of transparency, that level of trust, to allow capital flows, between our countries. And unfortunately, we haven't not been able to get there.
Yep. Thank you, and I yield back.
Thank you. We'll now go to Mr. Caston for 3 minutes for his questions.
Can you hear me okay?
Yes, sir, we can.
Thank you very much. Appreciate you having me on. Want to just follow up on a couple of the prior questions. I have a little bit of, and look, I'm completely committed to the idea that we need functioning capital markets, but the idea that markets are perfect predictors of the future would suggest that the 1929 crash and the stock market bounce that followed never happened. I'd welcome any of the panelists how they view. We've injected $3 trillion into the economy that has mitigated a significant part of nearly 40 million people's jobs. How do markets, in your estimation, view that companies will continue to have cash flows necessary to sustain dividends, when in fact the money, if we're doing what we designed to do, was going to workers, not propping up balance sheets? Are you suggesting that companies are hoarding cash in this moment?
That's actually exactly what we're hearing from investors. I'm sorry, Mr. Caston, this is Heather Slavkin Corzo from the PRI. That's exactly what we're hearing from investors. We're hearing concerns that businesses are hoarding cash, that they're looking out to the future and the uncertainty that they expect in the markets and the broader economy, and that they're not seeing the growth that, in fact, what we're seeing in the stock markets is completely disconnected from the real world experience of most operating businesses and most workers as well. So I think there's a lot of reason to be concerned about what the future holds, and a lot of reason to look at the conditions that are included in the way the Federal Reserve is distributing money to companies, because right now what we're seeing is that the lack of requirements related to job retention and stock buybacks and dividends and executive compensation and things like that are allowing the businesses to access the cash without necessarily meeting the obligations to preserve the economy that you all in Congress so wisely developed as you were trying to create a bill to stifle the negative repercussions of the pandemic.
So if I could, in the little time I've got left, the implication there, and clarify if I've got this wrong, is that as state and federal governments deficit spend, as consumers spend down their cash reserves, as small businesses spend down their cash reserves, are you suggesting that public companies are the one entity that's hoarding cash in this moment?
That is what the evidence seems to indicate.
This is Brett Palmer with the Small Business Investor Alliance. I would say that small businesses are trying to hoard cash as much as they can too. And the Paycheck Protection Program saved millions of jobs because it basically subsidized the non-economic behavior of keeping people employed even while your business is closed. So it really has worked. But all businesses, particularly small businesses, need to hold on to cash because they just don't know how long this is going to last. Many of them have drawn down on their credit facilities and are just trying to make sure that that the music doesn't stop on them. So the smaller businesses who have less cash to start with are trying to hold on to as much as they can and use the Paycheck Protection Program to keep their workforce in place and whole.
So thank you. And I know I'm out of time, but I totally support the Paycheck Protection Program. I just wanted to establish why it is that public companies, who by and large are not beneficiaries of that program, are showing the behavior that they are. And I think you've clarified for me why the stock market is maybe not a good bellwether of the bulk of the economy. It's not publicly traded companies. Thank you. I yield back.
Thank you. We'll now go to Mr. Style for 3 minutes for his questions.
Thank you. Thank you, Mr. Chairman, for holding today's roundtable. Appreciate all of us being able to come together and talk about some of these important topics. I'd like to ask Mr. Quaadman a question on emerging growth companies. As we look back at the Jobs Act, we allowed companies some flexibility in the regulatory framework to allow them to focus on growing their companies rather than on the regulatory burdens that in many ways we place in publicly traded companies. And as we look during this period of time, knowing many of the companies who've taken advantage of the emerging growth companies are biotechs, and knowing that there's a number of companies that risk losing this status, could you give a little color as to what you think the impact of losing this status would be on some of our smaller biotech companies that are currently struggling to get through this period of time?
Thank you very much, Mr. Style, for that question. Congress, on a bipartisan basis, passed the Jobs Act in 2013 because we had an over 20-year decline of public companies in the United States. That causes great competitive challenges, not only for the American economy, but for American workers and investors as well. The Jobs Act was an important step forward in trying to reverse that trend. EGCs are a very important part of that, where we are allowing companies to grow from small to large and to gradually work their way into the system of disclosures and controls that they need. The challenge that we face right now is that we have many companies that are EGCs are going to start to cycle out of that process. I would actually say there are many EGCs in the biomedical field are actually very important for our response to the COVID pandemic as well. So we think it is important to extend that EGC period of time to give these companies a chance to continue to grow past this crisis, and for also to help us to rebalance our public capital markets.
Thank you very much. If I follow up with another question to you, a slightly unrelated topic though, diving in on some of the work that our SEC is currently doing on proxy advisor reform, knowing that this is coming to the forefront, and I have a bill that's pushing this forward, which would codify much of what the commission is doing in this period of time where companies are increasing their balance sheets, with at the same time knowing that that really opens the door for some of these broader takeover moves. Can you comment that the impact that this would have if we were able to get through some of these SEC reforms on proxy advisors broadly on the market and big picture employment at some of these big companies?
Sure. The proxy advisory firm reforms that the SEC is pushing forward on, and that your bill would also codify, we appreciate your leadership on this, would rebalance the playing field to ensure that there's oversight of proxy advisory firms, which have an outside influence on shareholder proposals and corporate elections, but do so without any oversight or any transparency. That also it adversely impacts return for investors. And ultimately, as Commissioner Roisman said, institutional investors really have a fiduciary duty to the individuals putting money into their funds.
Thank you very much. I hear the beep, and so I will yield back. Thank you.
Thank you. We'll now go to Mr. Emmer for 3 minutes for his questions.
All right, thank you. Appreciate it. Thank you, Chairman, for hosting this roundtable wherever you are. Seeing as the Senate is already
Rayburn Building.
Okay, good. seeing as the Senate has already been able to return to work and do their jobs for the American people, I hope we will soon too reconvene and do the work necessary to reopen our economy and advance our capital markets. I've had a piece of legislation that would dramatically help reinvigorate our capital markets for more than a year now. Vicente Gonzalez is a co-sponsor of the bill. The top priority at the committee that was considered under a hearing in September, this legislation, which was unanimously passed last Congress, including by all members of the Financial Services Committee, would facilitate the creation of venture exchanges, creating jobs, improving capital formation, and encouraging more early-stage initial public offerings. Unfortunately, despite overwhelming bipartisan support and unanimous committee support last Congress, our committee has yet to schedule it for a markup. Today, the U.S. has half of the number of publicly listed companies than it had 2 decades ago. The Main Street Growth Act would allow the U.S. Securities and Exchange Commission to provide for the creation of venture exchanges again, which will help small and emerging growth companies gain access to the capital they need to grow and succeed. Mr. Quaadman, you have previously, I guess the chamber has previously stated that, quote, we believe this legislation is an important step towards properly tailoring market structure rules for small issuers. And although I'm sure you'd love to talk about PPP more and all the current things we're dealing with in the marketplace, I want to ask Mr. Quaadman, during this time especially, shouldn't Congress be taking every step we can to support and help re-energize our capital markets? And wouldn't this proposal, the Main Street Growth Act, help in a big way?
Thank you very much, Mr. Emmer, for that question. And as I said in my opening statement, this is a unique opportunity to press forward on many of these different proposals that can help reinvigorate our capital markets as well as our economy. The venture exchange idea goes towards one of the 2 problems that we have seen as to why companies are not going public, and that is the lack of liquidity, but also the lack of information and research. So the venture exchange bill would allow for the exchange and for market structure to be tailored in such a way to allow companies to access their liquidity. So this is an important, innovative proposal that we think will help jumpstart these markets and help companies grow.
Excellent. Thank you very much. I yield back.
Thank you. I will now turn it over to Mr. Sherman to conclude today's roundtable.
Thank you. I want to thank all of our participants for being involved, especially my colleagues. I want to commend Mr. Quaadman for his remarks regarding the PCAOB and Chinese companies. And I want to point out to Mr. Hill that when I used the word connivance, it was for transactions that I fear will take place in the future, deliberately designed to avoid provisions of the CARES Act, not for the interventions that we've seen on a massive scale in our capital markets so far. I want to once again thank the staff putting this together and my staff as well. And we're now adjourned.